Hi there, this is Christine Papworth, your real estate doctor. I'm here to talk with you today about the Mortgage Forgiveness Debt Relief Act of 2012. As you know, we've had this act around since 2008, and it is to protect people who either have lost their home to foreclosure or have done a short sale or a loan modification that has reduced the principal. And so it is about if you're trying to be taxed on your forgiven debt. So they just extended this law through the end of 2013. The problem is that the states, the individual states, have not all passed a law so that it shadows the federal law. So you may not be federally taxed on those properties, but you could very easily be taxed by your state if your state does not pass a shadow law. In fact, in the state of California, it took them almost a year and a half to pass the shadow law when we first had this bill. Gave us a few little problems. So make sure that you're talking to your congressmen, your senators, your assemblymen, your governors, and talking to them about making sure that they pass a law in your state that shadows the federal law. Now, that being said, I think we give a lot more value to this law than it really is. And there are a couple of reasons why. There are several ways to deal with taxation when you're dealing with a short sale or foreclosure situation. And here they are. So in order for this law to protect you, you had to have, it had to be purchase money, the loan that you bought the house with, and it had to be your personal residence. Now, if one of those two things is not true, even if you refinanced only to get a rate reduction, it is no longer a purchase money loan, and therefore you can be taxed, or you could be taxed on the gain. So, there are several ways that we can avoid taxation, whether it is purchase money or not, whether it is your personal residence or not. And I thought I'd outline those for you very quickly. First of all, of course, if you have a bankruptcy, if you do a bankruptcy in the same calendar year as the year that you either lost the property or sold it, then that protects you against all taxation, whether it's your personal residence or an income property. So if you have several residences, bankruptcy may be a good option for you. Another thing that protects you on all residences or all properties is the insolvency. Now, insolvency is a designation by the IRS. You have to fill out a form and it shows that you're insolvent. Basically what it means is that your liabilities outweigh your assets. And if your liabilities outweigh your assets and you are able to prove that by filling out this form, then insolvency says that there is no taxation on any gain that you may have, whether it's forgiven debt or any other kind of gain. So keep that in mind. Insolvency is, I've used it a lot with my short sale clients. The other thing that is something that a lot of people have not thought of, including accountants and tax preparers, is we have something called a one-time exemption. And the reason that this one-time exemption came along was because, you know, you might have paid $30,000 for your home in 1960 and now you're selling it because you're retiring for $600,000. If they didn't have an exemption to that kind of income, the taxes would kill most retirees, as you can imagine. So they came up with this $250,000 per spouse one-time exemption. So it could be a $500,000 exemption with two of you. The beauty, oh, by the way, little secret for you, this one-time exemption is now available to you every 5 years. So don't tell anybody, but it's a good thing, okay? Anyway, so if you use that, my accountant brought to my attention that you should be able to use the one-time exemption, whether it is on equity or on forgiven debt. That's a gain. What's the difference? There really isn't one. One, you're forgiven $200,000 worth of debt. The other is you have $200,000 in your hands that law will protect you from having to pay taxes on. So that is $500,000 right there if you're married, or $250,000 if you're not, that you can avoid being taxed on a gain from a short sale or a foreclosure. So all of those things can really help you. And that way, you don't have to worry so much about the Tax Relief Act, but it's still a good thing. Still make sure you talk to the people in power in your state to get that act passed in your state. Bye for now from the Real Estate Doctor. If you want to contact me, whether you're an agent who would like to know how to find out this information or a homeowner wondering what your options are, please check out my website at therealestatedr.com or therephd.com. And I'll talk to you next time. Bye for now.